This extreme bond market volatility we've seen this month as we wrap up the quarter, are we likely to see more of that?
Well, in fact, we would say that in terms of volatility, it may continue, given the fact that we have seen quite negative headlines, in the banking sector. In a way, investors are looking at two things. First of all, about the Fed action, what they're going to rate hike in May in the FOMC meeting. The second thing that they are looking at, would there be any other spillover impact and also other negative headlines going to hit the market? Talking about the Fed, we reckon that we are very close to the end of the rate hike cycle. However, at the same time, we reckon May could be having another rate hike. But we definitely think that there won't be any cut in 2023. The rate may stay elevated at this point, and will be affecting the market. And therefore, we see rising risk of recession going forward. Yeah.
Is a recession perhaps, and the risks of a recession being heightened in essence by what's going on with the fall of the amount of deposits into US banks, and that, of course, coming against this background of an inverted yield curve, which then causes this issue, this big problem, which, this question I've been asking, which is you've got banks with long-term assets and short-term liabilities.
Yeah, that's, one of the big issues that that creating sort of the issues at the moment. We reckon definitely, the banks need some sort of rebalancing of that particular strategy. At the same time, we reckon that's why the rising risk of the recession could affect the credit spread itself. And at the same time, what we prefer now on the credit side would be investment grade bonds, in which they are the one that we prefer over the high yield, mainly because in the rising risk of recession environment, high grade bond would definitely be the better place for the investor. We definitely now, given all the headlines, we will focus on quality credits. That's the area we will focus on at the moment. Yeah.
Do you think spreads can still widen, though? Or do you think this is a good opportunity to kind of get into that now?
Well, given the negative headlines, which may not die down, that soon, we may see other negative headlines in the market. We reckon credit spreads could widen out from here. In particular, as mentioned, Fed will pause the rate. However, the rate may stay elevated at this point. And therefore, the risk of recession is much higher. And that would also create some sort of pressure on the credit spread itself. So that's why, we like, higher quality credits here in Asia, as well as in the DM market. Perhaps, some investor, what they could look for would be, rather than going into the banking names at the moment, perhaps they can also look at some of the corporates here in Asia or in the DM side.